So actions and their effect on the P&L. We've got some scenarios here, please, Andreas.
So this is just a couple of examples to highlight what happens in certain cases. So the first one is if a technician leases a new car. So you see the revenue, direct cost, gross profit, indirect cost, and EBITDA before the lease. And when we then lease that car, you will have a direct cost impact of 5K. And after that lease, you will see how that flows through in the P&L. So prior to the lease, you had an EBITDA of 20, and after the lease, you now have an EBITDA of 15. So it's affecting your direct costs, reducing your gross profit, and then flows through down to EBITDA. So in this example, you are sitting at a 20% EBITDA margin. It reduces to 15%.
Thank you. And we've got the second example there about when the contract price is increased without a drop in volume.
Exactly. So price is one of our top priorities as well. We need to make sure that we receive the right price for our services. So the impact of a price increase is significant. So as the previous example, you can see the P&L before the price increase. You're sitting at a 20% EBITDA margin. You do a price increase, and that price increase, you deliver the same service, but it flows through directly down to EBITDA through GP, and you have a 25% growth in EBITDA, and your margin goes up as well to 25%. Or sorry, not 25% in this example.
Nice. Okay, so we have a couple of other scenarios here. We've got the purchase of chemicals that aren't used.
Exactly. So in a large company, we always use accrual methods. So in this example, we haven't used the chemicals to deliver the service, hence the P&L will not be impacted. So the impact will be on the balance sheet instead. So where you will see that the inventory will increase and the cash will decrease.
Okay, so there's like a delayed impact.
Exactly. The impact will happen when the chemicals are used.
So now in the next scenario, a customer buys a service for $100, but then doesn't pay for the service. So we have a bad debt.
Exactly. This is why it's so important for us to understand our customers and their payment terms, and also understanding the credits. Do we have customers that are getting close to a default and whatnot? Again, you have the same P&L as in the previous examples, an EBITDA of 20, a revenue of 100. But if the customer doesn't pay, we will have an impact directly all the way down to EBITDA. So you had indirect costs of -30. The customer doesn't pay, the cost increased by 100, and we're now looking at a result of -80. So yeah, our payments needs to be within the payment terms.
Yes. All right, thanks for those examples, Andreas, and thanks for making some of these examples using the simple numbers too, so it makes it highlights the cause and effect better. So finally, let's look at an IT manager buys a computer for $100 that will last for 5 years. What happens in year one?
So what happens is that the $100 for the computer is capitalized, which means the asset will sit on the balance sheet. And since it will last for 5 years, it's capitalized over those 5 years. So the value is then divided into 5. So you will have a cost of 20 in each year between year 1 and 5. So you're sitting at indirect costs of -30 in the beginning of the year. At the end of the year, you have an additional cost of 20. So you're increasing your cost by 20. And the result is that your indirect cost is then minus 50 compared to minus 30, and your beta result will be 0.
Because our overall effect is that the computer starts off as an asset, but by the end of 5 years isn't worth anything. So it's
exactly
depreciated out of use.
Yes.
Very good. Thank you. So that brings us to the summary. We have the executive summary. So we've got these key points here. Perhaps you could highlight these key points for us, please, Andreas.
Yeah, so what we've been covering is the financial statements overview, a closer look at the P&L, growth margins and goals, key financial metrics, cash flow and accounting standards we haven't really touched upon. But the most important parts have been covered in terms of the P&L and a couple of examples which has highlighted your effects on your P&L.
Thank you. And we'll distribute this PowerPoint to those in the class too, so they can study some of these points a little closer. Thanks very much for joining us, Andreas. How can we summarize this now? What do the managers need to do? So I've learned that the managers need to have a financial plan, and the managers need to understand the financial impact of that plan. But then there's this MMM. What's MMM?
MMM is the most important thing, I would say. As you said, I mean, having the plan and executing the plan and understanding the financial impact of your actions is the key focus. But then also to make sure that the initiatives that you're driving is giving you the effects that you're expecting, you need to manage, measure, and monitor your business. That's the 3 M's.
Excellent. And of course, you can always get advice from the regional manager, and Andreas and the national team are also there ready to help with any of the questions or advice that you might need. Thanks very much again for explaining that to us, Andreas. It's been very helpful, and it's been great to have that as part of the course.
Thank you, Richard.
And so thanks everyone for joining us, and don't forget to complete the short test below. And one last thing, of course, we'd love to hear how this has helped you at work. So send us an email to remember@learningsphere.com.au with your thoughts.